fun facts and staying true to youth development and advocacy.
Catch the action each and every Saturday as we roll out buzzy segments. What say you?
Youth for Chat,
Life Skills,
Global Connect, and Bust the Youth.
That's the Talk Up Youth radio show, Saturdays 11 a.m. to 1 p.m. on Nationwide 90 FM. Talk Up Youth, Miss Effie.
Talk Up Youth. Don't miss it.
Come into the parlor. There's a welcome there for you.
Welcome to the Mayor's Parlor with Desmond McKenzie.
From 1 to 6 p.m. every Sunday, you'll now get more of your favorite vintage music.
Put your head on my shoulder.
Nationwide 90 FM will transform your Sunday into a musical time machine that will take you way back.
Come with me. Let's go back in time.
This magic moment.
Journey into yesteryear with Desmond McKenzie in the Mayor's Parlor.
I've got the music to jog your memory and make you smile.
Put your sweet lips a little closer to the phone.
Sit back, relax, and enjoy the best in vintage music.
Come into the Mayor's Parlor every Sunday between 1 and 6 p.m. here on Nationwide 90 FM, a revolution in media.
Those oldies but goodies reminds me of you.
Not a mercy. This one is very classic, dedicated to all the schoolers who are taking beats.
If you've ever struggled to pass an exam, then you'll know that students today are under great pressure to get good grades and secure qualification needed to move on to higher education. The problem is that too many students are struggling alone and could really benefit from connecting with hardworking teachers and other bright students in other parts of the country and the region. Join me, Dennis Brooks, this and every Friday evening from 8 to 9, with a repeat on Saturday morning from 8 to 9. For the A-Team, a study group on radio, my team of teachers, students, and experts will break down the syllabus, giving you information, tips, and past paper questions that will help you get top grades in your upcoming exams. Follow us on Facebook Live and on Twitter and be a part of the community. It's the A-Team, Fridays at 8 p.m. with a repeat at 8 o'clock on Saturday morning. It's your free extra class on radio and social media. And it's right here on Nationwide 90 FM, the revolution in media.
Missing. If it pressure on no more, you're illiterate and foolish, you might on a cook. And you're not gonna get no work, and your teeth like a puss. Send me granny with a purse, I eat you off a joke. If I see them, I hold your red and big tonight, you puke, we look and say.
Good evening, Jamaica, and welcome to another edition of the A-Team Radio Show right here on Nationwide 90 FM, the best revolution station in Jamaica. And like I say, each and every weekend across the world, you're listening to the voice of Damian Scarlett, and it's so good to be here with you in this new year 2026. And because you're hearing me perhaps for the first time on air, I want to say Happy New Year to all of our nationwide listeners and viewers. And I trust that as you cross over into this new year and with the station and with the A-Team radio show, that you will learn something from this program. Students who are gearing up for their examination for CAPE, for CXC, this is the program, this is the place where you get all the examination tips, where we go through our past papers. And last time when we were here in December, we were looking at the whole matter of principles of accounts, and I have none other than one of the best tutors around the world. I don't just say around the world. We have Damian Chippy with us this evening. How are you doing, Damian?
Not bad. And evening to your viewers.
All right, great.
Viewers and listeners.
Yeah. Thank you for being here. Well, the last time when we touched on accounts and we were going through some of the principles and getting familiarized with some terms, we were looking at the whole matter of control accounts. We touched on accruals and prepayments.
Mm-hmm.
We started to look at a little bit of the errors and statement of affairs.
Yes.
So I know this evening we want to pick up where we left off, and we want to talk about depreciation, bad debts, looking at errors that do not affect the trial balance, right? So that's one of the things. And of course, errors that do affect the trial balance. Now, the term depreciation, we want to start there because if you do anything in banking or just a financial sector, credit union and those things, and any business at all, you come across that term depreciation ever so often. So let's start there and let's talk about depreciation.
All right, so depreciation with regards to the CSEC syllabus is also an adjustment topic. Okay. All right. Now, depreciation, the students would have known or should know that depreciation really is a loss of the value of any fixed asset at all. Yeah. All right. Now, the fixed asset is eroded by way, the value of the fixed asset is eroded by way of usage, the wear and tear. Yeah. You understand me? That's one way a fixed asset can erode. Yeah. I mean, I like to use the cell phone, the latest iPhone this year, and the next 5 years, it doesn't value the same as you when you buy it. Right. The year when you buy it. All right. So therefore, so depreciation is the erosion of the value of the fixed asset. But with regards to the cell phone, though, the type of the way in which it has been depreciation is really, based on obsolete, meaning that new technology comes in replacing the old technology and all of that. So the old technology you have prior doesn't really serve you very well, or doesn't really serve you anymore. So you move on to the latest. So that value has been gone down because of it's been obsolete. Right?
As you mentioned, the whole matter of the cell phone, another asset that comes to mind is the whole matter of the motor vehicle. It is oftentimes said that when you buy a car and as you drive that car off that lot,
it's the depreciate.
Right, the depreciation value. How do we navigate that in the everyday life? Because as a part of studying accounts, these principles that they learn from school is what they have to apply to
real life
situation.
And some of them may have the profession dealing with, and some of it is just really an everyday thing to understand.
Right.
All right. So now with depreciation, regarding to the CXC syllabus, there are two methods that they focus on how they go about calculating and determining a depreciating value of a fixed asset.
Yes.
All right. So there is the straight line method, and there is the reducing balance method. All right. Now, with the straight line method, also known as the cost method, it's actually fixed. So the value of the depreciation is the same year to year. All right. So that means if you say that it's 10% of the cost of the value of the fixed asset each year it will always be 10% of the cost of the value of the fixed asset, meaning that the cost value where you buy it for. All right. Then you have the reducing balance method or the reduced method. We talk about the reduced method is the one that it takes a longer time to fully dissolve a cost of a fixed asset because each year it gets lesser and lesser. All right. So unlike the straight line method, that is fixed irrespective of how the fixed asset is eroded, the reduced balance method is based on what is left of the value of the fixed asset. Depending on what is left of the value of the fixed asset, that's how you determine the depreciation of that fixed asset.
Right. And when it comes on then to dealing with the expense account, the depreciation. So
in accounts, the depreciation by itself is an expense.
Right.
Because, under this adjustment topic, it would have been depreciation and provision for depreciation. Students tend not to understand the difference between depreciation and provision for depreciation. They treat it for like one of the same. The provision for depreciation, also known as accumulated depreciation, is really the aggregate amount of year on year depreciation of the fixed asset. It tell you how much so far the fixed asset has been depreciated.
Okay.
So in the first year of the fixed asset life, the depreciation that you calculate is the same as the provision for depreciation, because that's the only depreciation that you have of the vehicle, or the fixed asset rather.
Right.
Now the second year, you still go ahead and find the expense for that year by finding the depreciation. However, you'd add the value of the depreciation that you find for the second year to the depreciation of the previous year to get the aggregate amount, the accumulated depreciation. And that is what they call provision for depreciation. Right. So this is what you put aside to say, okay, the value of my fixed asset is no longer 500,000 as I bought it.
Right.
It now value 2 year. If it's the second year in, you will add up the depreciation for the first and the second, and that give you the accumulated depreciation, or that's a provision for depreciation.
Okay.
Yeah.
So it goes, so the total accumulated depreciation it goes against what the actual value,
fixed asset value is. Good. Okay. But the depreciation in itself, it's an expense. You use it to assist, because that's the year in which you depreciate it. So you use it in your as an expense that you have, that has that thing set up on you, in order to calculate what is your true profit for the period.
And that goes in the profit and loss?
And that goes into the profit and loss.
Right.
So the depreciation by itself is an expense. The provision for depreciation is really the accumulative balance of your total depreciation so far.
Okay. In terms of formula, is there a formula that students can remember that now?
In terms of formulas, it's not like 6 you're going to present to your formula. So by way of practicing throughout the period, the students would already be comfortable with the formula. It's not difficult for them to know as long as they're doing their practicing. All right?
Okay.
Now, what students must understand that when 6E would have present a question regarding depreciation, how they present it, especially now, the now setting of the paper, they present it in a table-like, where students do consume arithmetic, so they can actually follow these things if they're good at maths. All right, so you normally get a table to just fill out some information in regards to your calculate. What you're calculating either the depreciation for the period, or you're calculating what is the accumulated depreciation, or you're calculating what is the net book value, the residual value, what is left of the fixed asset after it has been eroded. And those are very, very important. All right. 2, as I said to a student, I think sometime this week, not this week, last week, I was emphasizing that in accounts, the date is very crucial.
Yeah.
Because how CXC will ask these questions in regards to depreciation, they will ask you what is the value of the fixed asset, either at the end or at the beginning of a given year. What student must understand, if the examiner asks you for the depreciation, the net book value of an asset at the beginning of a particular year, you should know that it is the same value of the previous year just gone. You understand me?
Yes.
Good. So it's the same value of the previous year. That's the end of the previous year, which now becomes the value at the beginning of the new year.
Is that the revaluation period? Or?
No, well,
it
can be separate, but when you're going into revaluation, be careful, because you're going into CAPE.
Okay.
For the CSEC students, they should understand that, okay, if the examiner asks you what is the value of the fixed asset at the end of the third year or the beginning of the fourth year, it's the same value. The end of the third year, you would then find a depreciation added to the previous depreciation to get the accumulative depreciation, then deduct it from the cost of the value of the fixed asset. What left is now the net book value that they are familiar with, or the residual value. Now, that would be the value of the fixed asset at the end of the third year. Now, if they ask you for the value at the end, the beginning of the fourth year, it's the same, because you'd then transfer that closing value into the new period, which would have been the beginning of the fourth year. All right. So, I'm trying to get my students to understand that the end of the period of a previous period and the beginning of the current period is the same balance it carries.
Okay. I want you to hold that point for us as we take our first break right here on the A-Team Radio Show. We're talking about the provision for depreciation on our show tonight. So we'll be right back after this.
Like a puss, send me granny with a purse. I eat you off the joke. If I see them, I hold your red and big tonight. You puke, me look and say, book. If you pressure on your book, if you not no education, people treat you like a book. Turn you in a handyman, dog, food you off the cook. Them no want no candy man, no Barbie can no brook. So big up all the youths, a KC, Woolmers and men that brook. Me look and me sing and say, you now go to school, go on the bench and no chair.
It's undeniable that we should be together.
The true beauty of music is that it connects people. It carries a message. It speaks to you. It changes you. And that's exactly what we do just for you every Sunday as we take you to Urban Paradise, 9:10 a.m. to 11 a.m. Urban Paradise is our weekly musical journey that will serve up 110 glorious minutes of positive storytelling through music, mixed in with inspirational features to provoke thought and to heal the soul.
You're like a dream come true, just wanna be with you.
So join me, Diane Ashton Smith, this and every Sunday, 9:10 a.m. to 11 a.m. here on Nationwide 90 FM, a revolution in media. Urban Paradise, opening our hearts, connecting to others.
Me sing, if you pressure on no more, you illiterate and foolish, you might on a cook. And you not go get no work, and your teeth like a puss. Send me granny with a purse, I eat you off the joke. If I see them, I hold your red and big tonight. You puke, me look and say.
Welcome back to our show. This evening we are talking about principles of accounts. This is part 2 in our series. Last time we were here, we were looking at subjects or topics relating to control accounts, and tonight we're talking about depreciation. And if you missed the definition, depreciation is defined as the systematic reduction in the recorded value of an asset over its useful life. And we've been hearing some examples about the cell phone, the motor car, and which of course the cars. Would you consider the cell phone a fixed asset?
Depending on the cost.
Oh, okay.
Like normally you consider based on what your sales revenue is as against to determine whether this is a fixed asset or not.
Okay.
Because a stapler, we don't normally consider a stapler a fixed asset, even though the stapler can be in the business, because I have a stapler in my business for about 4 years. Yes,
okay. It's a staple item in the business.
But it's just that the cost with regards to the sales revenue, it doesn't match up. So you have to put that as an expense. So it all depends. And that a cell phone sometime can cost up to, the latest iPhone I think can be up to what? 200,000, 300,000.
About that in that range. Yeah.
There we go. Yes,
Yeah.
So some people that put it as a fixed asset, depending on the cost. So if you buy the other, like the bangers as they would call it, that's just an expense.
Right.
Yes,
And on that note, it should be said that the depreciation then is not a cash expense.
No, it's not a cash. It's not an actual passing of cash.
Right. It's an accounting expense that we have to book.
Yeah, it's an accounting expense that you have to give an account for in regards to. The truth is that the value of your asset does not remain the same. With the exception of your land and building premises and all of that tend to appreciate over time. You understand me? Other fixed assets tend to erode. So for business, what they do, they tend to they have to set aside these like a value to indicate the erosion of the fixed asset, because at some point they may have to just get rid of it from the business, right? And they want to know that when they get rid of it, it reflects. It is a true reflection of the loss of the value of it. You understand me?
Right, and then the depreciation is also charged then at the end of the period.
At the end of a business period, which is mostly a year.
Right.
You understand me? Yes.
All right. So is there anything else that you'd want to...
With the depreciation, student must also understand that in regards to the year-on-year method of calculation, it's not like this year you do reducing balance method and next year you do straight line method. You have to be consistent based on the consistency concept in account.
Right.
You understand me? If is it that you're going to use, by the way, one method, as we were discussing during the break, one method tend to reduce it faster than the other, which is the straight line one. Right? Now, so you can't just willy-nilly just change method. You have to have a note on the statement to state your reason of your change. All right, and it must be reasonable enough. You understand me? So you can't say I change because you want to probably evade tax, or you want to either hike up or reduce the value of your fixed asset for insurance purposes, or those stuff that can't be your reason. All right.
So I'll just have a little example here. So if we were to buy a motor vehicle car, well, a motor vehicle, because that's a car, a motor vehicle. Today is the 9th. So tomorrow I buy a car, the 10th of January, and I buy a car valued at 1.5 million, for example, and we want to keep it for about 5 years, and then we sell it for about, this is just a random figure, let's say $100,000. How, if we were to use the straight line method, then each year we'd have to...
All right, here's how you calculate that, because that's a perfect one. Because I mean, that's also a question that CXC would have actually thrown onto the students. You buy the car for 1.5 million.
Right.
Your useful life, where you want the car for in the business, is 5 years.
Right.
However, at the end of the 5 years, you want to just scrap it for $100,000. The truth is, your total depreciation for that 5 year would have been $1.4 million. You understand me? Because you subtract 100,000, because the 100,000 that you say you want to just scrap it for is the scrap value, or reduce the net book value, or residual value, as they call it. You get that? That is the value of it at the end of the period. Then now, because you know that you're going to have it for 5 years, you are then now going to then divide the 1.4 million divided by 5 to see what is the yearly depreciation. Every year is that fixed amount. All right, so that's 1.4 million divided by 5. That would be about what?
Let's get the maths right. Divided by 5 or 4?
Divided by 5, because it's 5 years. It's nearly 300,000.
300,000, yes.
Yeah, nearly 300,000.
Yeah.
You understand me? So therefore, every year.
That would be the figure that becomes the reducing.
Not the
reducing balance,
the
but
straight
the straight
line
line
method.
Right.
So that is a perfect example of a straight line method. The reducing balance method regarding the exam is normally associated with just giving a percentage. Right. Although the straight line can be also associated by giving a percentage, but that's another method for calculating the straight line method.
Okay, so for example, then if the question asks for you to calculate the reducing balance by 10%, then it's a 10% that you use.
So 10% of the 1.5 for the first year. There's no previous depreciation. Because that's the first time you're buying the car.
Right.
You get that? Yeah. So therefore, you wouldn't have any other depreciation to worry about. So it'll be similar to the cost the first year of calculating the depreciation of a fixed asset by the reducing balance method. It would be similar to the straight line method.
Okay,
however,
thereafter
now,
yes.
Whatever the provision for depreciation is deducted from the cost, and then you find the 10% of that reduced value. So 10% of 1.5 would be 150,000.
Okay.
So therefore, the first year depreciation is 150,000. Then going into the next year, you subtract 150,000 from your 1.5, that give you 1.35. All right. So therefore, you would know that you find 10% now of 1.35 million would give you 135,000.
Right.
Yeah, so you realize it reduced from the first year, which is 150,000, to the second year, which is 135,000. So that's why it's called the reducing balance method, or the reduced value method.
And this is what they have to. So in terms of booking this expense, now where does that go?
All right. So this expense, in terms of what? Sorry, could you repeat?
The figure.
The figure goes into the profit and loss.
Profit and loss, right?
Good.
I want to get that.
That actual figure goes in, because that is the depreciation for the year. However, using the reducing balance method with the example that we just gave a while ago, the 150,000 plus 135,000 would give it 285,000. You understand me?
Right.
For the second year, the total depreciation, which is also known as the provision for depreciation. You get that? And that goes in the balance sheet to set it off against the costs at the end of the second year, to know what is the value at the end of the second year. That's how it works.
And when we had started, last time we spoke about the principle of the double entry, and it's the same thing
because expense,
right?
Regarding the double entry, an expense is a debit entry, because, well, how I teach my kids about expense is really beneficial to the business.
Right.
You know, for some business people, them see it as a negative, but it can't be, because, you know, your light bill, it benefit your usage of electricity, benefit the business throughout the period in which you operate. In fact, without the electricity, you can't, as it is now, you can't stream live, you don't have lighting, and all of those stuff.
It becomes a part of what your overhead or your operating.
Good. So it's beneficial. So any benefit is treated like an asset. You treat it like an asset.
Right.
So that's how I teach my kids how to deal with expense.
Okay.
Yes, I mean, even going, doing your own business. Many business people, they tend to try to evade some sort of costs.
Yes.
That these costs, it's not like it's unnecessary. These costs are, relevant costs, that must be taken into consideration. They try to evade it on a matter of, profit margin, right?
Yeah.
Which doesn't work well for them in the long run.
Yeah, there's a lot to unpack when you come onto the business world, And it's good to learn these things from an early age, because we have a number of our students who want to become entrepreneurs and to have their own businesses. So these little principles that you're learning in POA and POB, and even of course carries us a far way. But that's it in terms of the basics there for depreciation. I want to switch over to bad debts, but we can do that now?
Yes, we can.
All right, so just like depreciation, that also carries a provision for the depreciation. We know when it comes on to bad debts,
good.
There's also a provision, but if we were to give a basic definition of bad debts, because maybe a lot of people want to hear this part now.
So bad debt in itself is just simply a debt that has gone bad. Somebody who owe you initially, they are not able to pay you. Yes, but I further put it there. It's not necessarily that they just now go pay, or they just don't want to pay, or they're not able to pay you, on the basis that they are bankrupt, which bankrupt you have to go through the court. You understand me? And 2, dead. Yes, I mean, a dead man.
They can't get that back. It's uncollectible.
But the truth is that, that's how I teach it in accounts. How do I know that in the real grand scheme of things, if you have an estate, whatever your liabilities are, they tend to set it off against the estate. All right, but for them to really understand the concept of bad debt and provision for bad debt. So bad debt is simply where a debt has that you have a customer or whoever owes you is unable to pay you on the basis that they are bankrupt, are not able to pay, or they are,
going through some kind of challenge.
No, well, whatever the challenge is, they should take it to the court if you can't pay your debt to declare bankrupt. So, as my students would say, then that means, sir, if some of them can't pay me, so I got some bankrupt. And I tell them that bankrupt is for you to take it through the court.
Costly, of course.
Cost, number 1. 2, it's an embarrassing procedure, because now, publicly now, you're saying to anybody who may wish to do business with you to be cautious.
Cautious of what you do.
What you do.
Yeah.
So nobody no really go want to extend to you any sort of credit, any at all. So,
and in our country, we have seen where companies have declared themselves bankrupt
as well,
and going through that process. But the difference then with the bad debt and the provision is that where the provision for the bad debt is concerned, that is where with the company we do the.
In other words,
right.
So bad debt is an actual debt that gone bad.
Right.
Good. However, provision for bad debt is simply where you suspect that a debt may go bad. So it may or may not.
So you have to put a provision in there.
Go. You have to put a provision, put aside part of the debt, part of the debtor balance to indicate that, okay, I may not collect this amount of money. But the truth is that it's not an actual debt that gone bad. It's just that it may or may not.
Right.
You understand me? Right. So what I normally use to emphasize to the kids about the provision for bad debt, for them to really get it, I would give them an example that, you lend a friend your lunch money. Yeah. And every day, they said about pay you back within a week. And I tell you, every day after that week, some hard luck story them come with, or they try to hide you.
Right.
Yeah, people stay already. You have to be realistic to say that it's a possibility that you will get back this money from this person.
And part of that provision, from what I understand as well, is also to help to position the company to look at how healthy in terms of the financial health of the business.
Well, as you said that, it's a part of the prudent concept you have to be very prudent. You have to be very practical.
Right.
You can't just year on year on your balance sheet having this big debtor balance to look good on your balance sheet when you know well that you may not get back all of this money.
Yeah.
So you have to be, so the accounting concept, have us business in reporting. We must be prudent in reporting, mean practical.
Right. And I guess these are some of the decisions that are made at the management level when you look at the accounts ever so often and say, well, we are at a point now where we have to take this off the books.
Yes.
Yeah. Well, I want us to hold that point, and when we come back, I think this conversation is getting very interesting. I feel like I wanted to sexy again. But this is the A-Team Radio Show. We're talking about the depreciation and bad debts. And when we come back, we'll pick up on that conversation. Soon come.
And you not gonna get no work, and your teeth like a puss. Send me granny with a purse. I eat you off a joke. If I see them, I hold your red and big tonight.
Oh God, once again.
Sunday is a day for reflection and praise. So start it with Lutheran Ministries in Jamaica.
God, we know you're gonna bless us.
Listen to Nationwide 90 FM every Sunday morning at 8:30 a.m. for the Lutheran Hour. Brought to you by the Lutheran Ministries Jamaica, located at 33 Courtney Walsh Drive in Kingston. That's the Lutheran Hour, Sundays at 8:30 a.m. on Nationwide 90 FM. The new revolution in media.
Visit or contact the Jamaican Lutheran Hour at 33 Courtney Walsh Drive, Kingston 10. WhatsApp or call 876-348-9085. Find us on Facebook at Jamaica Lutheran Hour or email lutheranh@gmail.com.
Me sing, every pressure no more. You illiterate and foolish, you might on a cook. And you not gonna get no work, and your teeth like a puss. Send me granny with a purse, I eat you off a joke. If I see them,
Welcome back to the A-Team Radio Show. We're in the second half of our program this evening, and we are talking with Damian Chippy from Chippy Tutoring Services. Tonight we are continuing part 2 of Principles of Accounts, and we are learning the basic principles. We are going through looking at depreciation. We're now talking about bad debts, and a provision for bad debts, which is the estimated percentage of the total, or we should say doubtful debt then, that must be written off during the next financial year.
So the provision for bad debt is normally you give an...
Is an estimated figure?
An estimated figure. You can either give a percentage, and again, these are normally directed or dictated by management.
Yes.
You know what I mean?
Right.
Directors of the organization. All right. Now, and again, they'll be looking at numbers to come up with that as well. Now, the reality about bad debt, as I normally say to my students in real life, I mean, it's a for some business, it's a very scary thing for them.
Yeah.
But the reason why they may have bad debt is that they're not good at collection. They're receivable. With the receivables, students would know that account receivable is debtors. You get that? Mm-hmm. So you're not good. You're not managing your receivables very well. So therefore, it get out of, as times lapse. People get older. They get whatever. They get sick. They whatever. So they become more. The probability of them paying the debt becomes slim. Yeah. So I mean, if you're not managing your debt very carefully. Right?
But one should, for businesses, then one should not. At the start of the financial year, when you're doing that planning for that budget, do you estimate a provision at that point?
Yes, you can, because again, your estimation would have come from
the previous year,
prior years coming to see, a trend. Because you can pick up on a trend to involve in the estimation. All right. Right. So you watch your figures and you can make an estimate that you may not collect this amount. You understand me? And two, also you can reverse it by how you put things in place. Your debt collector, or you pass over the debt, selling debt to somebody else to go after these people. You understand me? Who keep on who owe you. Two, what you can do is you can, as going back to control account. Control account is help you manage that as well to see. You're careful not to either trust your goods too much, or if you're a particular debtor, a customer, you watch them to see, okay,
just minimizing the risk.
How well they pay back and all of that, and you determine that, do I have a limit on this person or not, or what? So you have to be very careful, right?
How long, or ideally then, should a bad debt be on the books of anybody's?
Should a bad debt or debtor be on the books?
Right.
Really, within a year. So yes, depending on the debt. If it's a short-term debt, yes, I mean, so especially debt that is due to trading, it's not good to talk about having that debt for over a year. Although yes, that still do happen. So it's a matter of either you, the business person, is being very lenient with the person, or because you take it to the court to try to obtain your money. You know what I mean? Because it's you're dealing with people, and again, as long as human beings can get away with something, they are going to do it. You know what I mean? They are going to do it.
One of the things I wanted to find out is that, though we're talking about where some of these things, which account we find them. In terms, I want to go back to the double entry now for the bad debt. Is that recorded in a journal, or is that somewhere?
So you record it in a journal first. Okay. All right. Again, bad debt is a non-cash
expense.
So it's not a real cash passover or whatever, like depreciation. So that goes right into the journal. Bad debt, as you know, it's also an expense,
right?
Because what happens is that the business is absorbing the costs of not collecting these debts. So it's a cost to the business. Anything that is a cost to the business would be classified as an expense. Yes, I mean, so
and that's increasing.
Good. So so that's once you incorporate bad debt, it's an increasing expense. So therefore, expense. In the double entry ruling, expense carry debit balance. Yes, I mean, and it is set off against the debtor. The debtor who is an asset is now reduced.
Right.
A reduction in the asset based on the double entry ruling goes on the credit side, and then the expense itself, which is the bad debt, goes on the debit side. All right.
Right.
But the provision for bad debt, likewise with the provision for depreciation. Now, the balance of those, the provision for those expenses is a credit balance, because it's like again, for the provision for depreciation, you're putting aside an amount to offset the asset itself, which is the fixed asset. So likewise, for the provision for bad debt, you're putting aside an amount to offset the debtor.
And that's on the credit side.
All right, so that's on the credit side.
And profit and loss, then you'd have to debit your profit and
Good. So with regards to so the expense, the bad debt, is debited in the profit and loss. It's an expense.
Right.
So now, the provision for bad debt, though, it all depends. So this one is a very tricky part that teacher would have some sort of challenge to teach your students how they treat it in the income statement, how they treat it in the balance sheet. Now, for the provision for bad debt, while bad debt in itself is very easy, it's an expense gone bad, done deal. It's an expense. So they put it right in the expense portion of the income statement. However, the provision for bad debt is a depend. It can be a revenue as well as it can be an expense. Yes, I mean, when it's a revenue, is if it means that based on your suspect that a debt may go bad, but the reality is that it's less than you thought. So you put a provision last year, say $1,000. You may not collect $1,000.
But you might get back half of that.
I mean, but this year now it has been reduced, said to $200. So you realize that you have an $800 difference between the $1,000 last year and the $200 this year. So that would have been like money that you never foresee. You understand me? So that would have been a revenue right there. So that goes into it. So the decrease in provision for bad debt, the difference between the year and year is a revenue. However, if it increased, the difference between the year and year is an expense. All right? And then now, the provision for bad debt further going to the balance sheet, which is a statement of financial position, where you deduct it, the actual provision for bad debt is then deducted from the debtor balance. Because, again, the provision for bad debt is an amount that is set aside from the debtor balance on the basis that you suspect that, you won't be collecting this amount.
Okay. And so does that have to be as a part of a provision account as they move on?
So you have, just like you have a bad debt account, you also have the provision for bad debt account. So we teachers, just like with the provision for just like depreciation, we have to have a depreciation account, we must have a provision for depreciation account. You have a bad debt account, you must have a provision for bad debt account. But the provision for depreciation account show the accumulative effect of the total depreciation year on year. But with regards to the provision for bad debt, what it does is shows the difference in the year on year provision, whether it's increase or decrease. You understand me? That difference goes to the profit and loss. However, the actual provision for bad debt is what would be seen as the balance. Right? So teachers have to be very careful in how they deliver this part of the syllabus, because the students can come out either enjoying the class or the students can come out seeing it as a painstaking. Yeah.
What would the examiner ask in under this topic, though? Would they ask for them to?
Yeah, they'll ask them. They'll ask them to do the calculations.
Okay.
How they do the calculation for both the provision for bad debt or the bad debt, if they give them the way how to calculate it. Or two, they will ask them to also do a bad debt account or a provision for bad debt account. Three, they will ask them to show how it would be like, how it would be like in the income statement as against how you'd treat it in the balance sheet. So we call this the profit and loss extract and the balance sheet extract. So it's like that segment or that fraction of those statements to show you how the provision or the bad debt has been treated in those statements.
And in doing that, they still have to do the regular process, write up the T accounts and to show.
So they write up the T account, yes. And again, nonetheless, you still understand the double entry ruling. But then again, so students should know that the bad debt is just an expense. So, and then they close it off to profit and loss at the end of the period. But the provision for bad debt, when they're doing the T account for the provision for bad debt, they know what is the provision, how they get the provision for bad debt in the income statement. It all depends on the fluctuating year-on-year difference between previous year provision and the current year provision. So, because sometimes that can be and revenue. If it decreases or if it increases, it's an expense, and they have to know how to treat them.
So it is clear then that we need to look at what's happening in each year.
Yes.
As the financial year goes on. Right?
Good.
Okay, great. So we're learning a lot. We're back in the classroom. We're looking at bad debts and the provision for bad debts. And if you're operating a business and perhaps you're listening tonight and you're a student and you're operating a business and you're wondering why I can't collect the money from so-and-so, you're learning about those principles. When we come back, we want to talk about the errors that affect and do not affect the trial balance. This is the A-Team Radio Show. We soon come back after this.
Work and your teeth like a puss. Send me granny with a purse. I eat you off a joke. If I see them, I hold your red and big tonight. You puke, me look and say, if you're not no education, people treat you like.
Make an impact on your career. Earn real money. Get 3 to 4 local and international certification in practical nursing and early childhood education with free CXC or CAPE subjects in 6 to 12 months at Distinction College, located at 26 Hagley Park Road, Kingston, 6 Nugent Street, Spanish Town, and Ocho Rios. Earn global certificates in 3 months in geriatric nursing, phlebotomy, childcare. We have the lowest school fees around. Classes begin very soon. Call us 356-4167.
Come into the parlor, there's a welcome there for you.
Welcome to the Mayor's Parlor with Desmond McKenzie.
From 1 to 6 p.m. every Sunday, you'll now get more of your favorite vintage music.
Put your head on my shoulder.
Nationwide 90 FM will transform your Sunday into a musical time machine that will take you way back.
Come with me. Let's go back in time.
This magic moment.
Journey into yesteryear with Desmond McKenzie in the Mayor's Parlor.
I've got the music to jog your memory and make you smile.
Put your sweet lips a little closer to the phone.
Sit back, relax, and enjoy the best in vintage music.
Come into the Mayor's Parlor every Sunday between 1 and 6 p.m. here on Nationwide 90 FM, a revolution in media.
Those oldies but goodies reminds me of you.
Me sing. If you pressure no more, you illiterate and foolish, you might on a cook. And you not gonna get no work, and your teeth like a puss. Send me granny with a purse, I eat you off a joke. If I see them, I hold your red and big tonight. You puke, me look and say, if you pressure no more, if you not no education, people treat you like a book. Turn you in a handyman, dog, food you off the cook. Them no one no candy man, no Barbie can.
Welcome back to the A-Team Radio Show. You are listening to the voice of Damien Scarlett. I have with me as my guest Damien Trippy. We are continuing our conversation on the principles of accounts. This is part 2. We had part 1 last month, and we're back again with part 2 in the last segment of our show. And we want to touch a little bit on going back to the trial balance, but talking about the errors that affect or do not affect the trial balance. If you remember some time ago, if you were following us, we were talking about the errors, the errors of omission. We mentioned some of those things, right?
Yes.
The errors of commission. So let's talk about that, because the trial balance is very critical. You need the trial balance as you talk about developing you need the trial balance
in order to do your income statement, your balance sheet, your cash flow.
Right, and all of that, and especially if your cash flow, you really need that. So let's talk about some of those errors. Let's start with the errors that do not affect the trial balance. So.
All right, so errors, as I tell my students, everybody, no matter what level of practice they are with accounts, you're going to make at some point some errors. You deal with numbers, and sometimes if you don't be careful, you see the numbers that jump around. Yes, so therefore, so it's not nothing on your part, nothing lacking on your part while you're being this. It's natural. It's one of those professions where it's natural.
I know.
So therefore, you must have a procedure of how we correct these errors when they are, they have been caught. You see them and all of that.
Yeah.
And because the truth is that we have two type of errors. you have the error that will not affect the trial balance, meaning that the trial balance, both the debit and the credit column will agree.
Still agree and still balance.
Right? And so we're focusing on that one. Now, regarding the CSEC syllabus, we'll tell the children about 6 or 7 of them. All right? The error of omission where a total transaction was totally left out of the books because you didn't record a debit nor a credit. The trial balance will still agree because you didn't put nothing on the debit side and nothing on the credit side, so it's still as it is. All right, so it will not affect the trial balance. Now we're saying that although these errors do not affect the trial balance, what students should understand is that they do affect other areas. They affect your total liability, your total assets that you have on your balance sheet. You understand me? And it also either understate or overstate your profit. So the truth is that it's important that you get to the bottom of these type of errors. Right? So the error of omission, the transaction is completely left out. How you correct these errors is, by the way, errors are normally corrected in journals. But what I do stress to my students, even since we started teaching errors, good. No, I stress that student, what goes into the journal is the action that was taken to correct the error, irrespective of your knowledge of the double entry ruling.
Okay, that's a quick clarification. Is it the general journal or the specific journal for each of those?
No, the general journal, you correct all the errors in. That's the general journal. Cause you have different types of journal,
right?
But it's the general journal that is used to correct the errors. So now, again, they must understand that is the action that was taken to correct the error. That is what is recorded in the general journal. Some of them, might understand the double entry ruling and I say, they're not looking at the optics that, look, they know sales carry a credit. And for some reason, they can't see why is it that I would debit the sales, put in the journals. But, when we have to remind them, it's not the double entry ruling you're following in this regard, although in some retrospect you're following the double entry ruling really, but it's just to reverse something that was done. All right, so if it means that to reverse a sales that was not taken, sales carry credit balance, to reverse that sale that was not really taking place, you have to credit it. Put it on the debit side to erase it or to reverse the entry that you have made initially. So what you do in the journal is you're not saying that, sales carry debit balance. You're just saying that I'm reversing the entry in order to make the correction.
Right.
You understand me? So sometimes reversing the entry, sales that normally carry a credit balance, you have to debit it to reverse the entry. So when I'm teaching this topic, I have to be constantly reminding students that remember, it's the action that you took. The action that was taken to correct the error. And that is what we record.
And that's a life principle, because when you work in accounts or banking, finance, you understand that, especially if you're in the general ledger department, you have to write your journals to correct and reverse those entries.
Good. Yeah. So you have to have the knowledge of the double entry. If you don't have the knowledge of the double entry, you make more errors.
That's right.
For that as well.
And then you end up having more, like 4 errors when it's should be 2.
Exactly. All right. Yeah. So, and then now you have the error of commission. Now, although error of commission is simply on the basis of stating that it can be the right class of account, but it's just the wrong account.
Right.
So, for instance, you have 2 expenses. You pay for an electricity bill, but instead you put it to telephone bill. So it's the right class, but it's the wrong account.
Right.
That's still an expense account, but you put it to the wrong account. You may buy an asset, you buy a motor vehicle, but you say it's a machine account. You understand me? Right. So it's right class, wrong account. But what the CXC normally challenge them with regards to error of commission, in which I tell my students, they treat it like wrong name account. So like you're supposed to put it in M. Jones account, but you put it to M. Johnson. Right. And again, on the basis that the names are very close so sometimes you can mix them up. right?
Or John Jane or
yes.
something, right?
So it's the right class of accounts, meaning that they are personal accounts. These are accounts of the name of a person or entity. It's just that you put it in the wrong one.
Right. And the debit and the credit still equal.
And the debit and the credit is still both the debit and the credit side is still equal, because it's not like it's just that is the name, is the account is the wrong one.
Right.
The class and everything is okay.
Class is right, figure is okay. Just that, as you said.
Good.
Right.
The wrong one.
Wrong one.
So in order to correct that, you reverse the wrong entry that you have made from the account. So you buy you buy goods and credit from M. Jones, but you mistakenly put it to M. Johnson. So if you should record M. Johnson on the basis of the credit purchase that you do, you'd credit M. Johnson account.
Right.
No, you never buy from M. Johnson, so now you have to reverse that by debiting it to reverse the entry, the credit entry that you have made. And then you make the right recording by putting it in M. Jones account.
Right.
So you then credit M. Jones. So you debit M. Johnson, and then you credit M. Jones. That is what is reflected in the journal.
Right.
In order to correct.
And I remember, when I was in banking, the 10 and the 81, in terms of, that's what we use in terms of the code. In terms of credit and the debit.
Oh.
So you know what to use as credit. And when you write in the journal, so you know that you put is the 81 there, so for credit, or the 10 for a debit. Or
oh, if I had a rhythm.
A rhythm to work it out. But as you said there, so commission, the complete omission, and then commission. And
then you have the principal now.
Right.
The principal is the wrong class.
Okay.
Good. So you buy a fixed asset, but you take it and think it's an expense. Yes, I mean both fixed asset and expenses debited, so it would not be picked up in the trial balance.
Right.
You understand me? Another example is where you buy a fixed asset and you treat it like a goods you buy. Again, the purchases carry debit entry, so therefore it would not be picked up nonetheless. All right. Then we have error of omission, error of commission, error of principal. Then we talk about errors of original entry, where you made the entry from doing the journals, the books of original entry, your journals, your 5 journals, your sales journals, the purchases journals, return inward journals, return outward journal, general journal, cash book, petty cash book. Those are books of original entry. You understand me? So you could have made your error right there. What happened is that whatever the error that you made there, you transfer it to the ledger. So you see, the double entry ruling would have still holds true on the basis that you put it in your books of original entry.
Right.
All right. And then you post it to the ledger. So the error won't be picked up. So that is error of original entry. All right. Then we have the complete reversal of entry. Right class, right account, right amount, but you just put it on the wrong side of both accounts. For instance, when you bought goods for cash, purchases would have been debited, cash would have been credited, but you make a mistake and debit the cash and credit the purchases. In order to correct that error now, you'd have to double the amount to correct it. The first half is to take it out from the wrong side, and the second half is to make the right entry.
Right.
So in other words, you double the amount. And I, love to give the students the example, like, I went to the bank. I won't call the name of the bank. When I went to the bank and the drive-through, the cashier gave me, I'm supposed to withdraw 300 and 1,000, but the cashier did the wrong entry on their part. So therefore, while I get the money, it's after when I go online and looking at the activity online, I realize what the cashier had done. But I tell the students it's nothing for me to jump to joy, because when they're reconciling, because you have bank reconciliation,
you'll see it on your back statement.
Yes, I mean,
say reversal of entry or entry reverse.
So when they're reconciling the various accounts, they're going to pick up on that.
Yeah.
So all I do is just ensure that I have double the amount to ensure that when they're ready to take back the money,
right? Because
they will.
The individual might see it and say, "Oh well, I'm rich. I have more money now."
The only thing that was good for me is that they couldn't charge me on that excess.
Right, because it's not your fault.
Yeah, so that wasn't a fault of mine.
And what that shows you as well, Damian, is the importance of, some people don't check statements. They just spend and spend and spend.
Oh, man.
It's important to check your bank statements because you need to know what is happening in your account.
Yeah.
The charges, the reversals,
and especially
when they happen.
In this technological era where money can just be missing from people, account.
Yeah.
You know, it just...
I think it's a part of you exercising that kind of prudence as well, so that you ensure that you check and you double check. Well, I know I'm almost out of time now in this for this program, but certainly as we get closer to the exams, I know you're going to be coming back to do some past paper questions with us, because what we're trying to do is to maintain a series so we don't break it, right? So we'll have you back on to do past paper questions for accounts, but just a general principle or a message that you want to leave with the students and even for teachers as well as they continue to teach throughout the semester.
All right. So with regards to accounts, I must say for teachers, it's very prudent for us to ensure that we pass on the information in the way that it's according to the syllabus in the exam that they're preparing for. And you have to be very deliberate with that one. If you're not deliberate, it's going to bring about some confusion. So you have to be on par with what the syllabus is about, and you teach the students, or you impart the knowledge as such. All right? Two, for the students, it's very important that you follow the advice of your teacher. You go to class. Right. You can either read upon before, or you ask a question so that you can get a clear understanding of the topic, because accounting is becoming increasingly difficult. That's what I see in regards to getting the students ready for the exam. Although, in my view, it's easier than the time that I have done the exam. So the analytical approach must be taught by teachers to have students better ready for the exam.
Yeah, thank you for that. I definitely, when we have you back, we're gonna ask you to answer this question, because we're out of time now. But I'm seeing in the comment section here invaluable information that we've been getting, and I see Marigold also saying that a cash book is sometimes tricky to balance, and she says, excellent execution, Mr. Chippy and team. So we'll have to talk about the cash book when we come back, right? The cash book, and then we're going to be looking at some of the past paper questions. That's where we're going to be leaving it for tonight. This is part 2 in our accounting series here on the A-Team Radio Show. I want to say thank you so much again to Damian Chippy, our executive producer, Dennis Brooks, and of course, the man that keeps the show going and operating behind the cameras and the glass, as we would normally say. Of course, Andrew Anderson. Until we meet again next week, I want to wish you a wonderful night and a great weekend.
Them no want no candy man, no Barbican, no brook. So big up all the youths a KC, Woolmans and Meadowbrook. Me look and me sing and say, you now go to school, go on the bench and no chair. School lads just wave on no hands in the air. You know a rectangle depend from a square. Pronounce your words, them loud and clear. Textbook now have no dog ears and them no care.
Exciting news! The Design Studio Nationwide